Hello and welcome to this video. Today we're going to discuss how to determine the correct position size for your account, ensuring you don't over-leverage yourself, and also discuss some useful techniques when it comes to opening and closing positions. Whilst all traders want to make that big trade which doubles, trebles or even quadruples the trading capital on their account, the fact is that this rarely happens. However, if you do place those big trades which use up all your trading capital, then you are much more likely to wipe out your entire account within a few trades. Even if you get it right a few times, the one time you get it wrong could well be an end to it. So instead of using all your trading capital for one trade, which could then wipe you out, you're much better off using effective position sizing techniques within your trading strategy. Successful traders, no matter what asset they're trading, will vouch for the importance of effective position sizing techniques. Now this, put simply, is ensuring that the size of the trade that you're opening is not too large for your account. A simple way to understand this is that if you find yourself thinking about your positions first thing in the morning or even last thing at night, then it's simply too big. The most commonly used method for deciding your trade size is as a percentage of your overall trade funds. Some people who don't trade with stop losses may use the technique of the trade size being a fixed percentage of the funds. In this case, trades should never be more than 20% of the overall account balance. However, to trade properly, risk management is critical, so we will work on the risk that you're taking per trade in relation to your overall account balance. A general guidance for the risk on a trade should be around 5%. Even when trading with a stop loss, the margin utilised on a trade should still be no bigger than 20% of the overall account balance, with 5% as the risk. So, for example, when trading with a CFD and utilising the 20% margin, on an account with £10,000 in trading funds, you should be looking at using no more than 20% or £2,000 in margin for a £10,000 position, and look at risking no more than 5% or £500 on each trade. This keeps the risk per trade contained within the margin set aside and manageable. This way you're also giving yourself the opportunity to build your account up slowly and steadily rather than blow it up quickly. If the trade doesn't go to plan, then you can get out with the chance to re-evaluate the trade rather than watch it spiral out of control. If you do opt for the 5%, don't then trade an asset which comfortably swings 5% a day, because this can easily mean the trade could close out early on short-term moves. But for this reason, we do say it's a general rule and guidance. If you do decide to trade a higher volatility stock or instrument, and have already determined your maximum risk tolerance is 5% of your standard trade size, or £500 as previously discussed, then a useful technique is to halve the trade size and double the risk percentage. So, instead of say 5% risk on a 10k trade, giving a cash risk of 500, then look at a 5k trade with a 10% risk, still risking the same amount of cash, but effectively acknowledging the higher level of volatility in the shares. The first advantage of planning your trade size by a percentage rather than a fixed amount is that your trade size will increase or decrease depending on whether you manage to grow or reduce your trading capital on the account. Secondly, you're much more likely to follow your trading rules with a smaller size position. If a trade is too large, you'll often bring your emotions into trading, and emotional trading is rarely successful trading. So, once you've established your trade size, the next thing to look at is how to enter the trade. Getting the exact right entry is easier said than done, and those that focus on this too much can often end up missing an entry entirely. Remember, it's always better to be approximately right than exactly wrong. And seldom does anyone ever get in at the exact right price. Often the exact right price also only becomes apparent after it has come and gone. Another useful technique that traders use is scaling into the position. And this is basically adding units to your position or splitting the entry points. For example, following the rules on trade size, you've decided that your position should be £10,000. When you're scaling into it, you do not place one trade of £10,000. So instead, you look to build up to that position size over time, buying, say, £5,000 twice or £2,500 four times. There's an extremely positive psychological benefit to this approach. This approach takes away the need to be perfect in your entry point. No one can consistently predict the exact turning point in a market. Here, you identify an area of entry. If the price moves lower from the original entry level, you're quite happy, as you now can build to your required amount at a lower average price. If the price moves up, you can still be happy, as what you've bought has gone up in value. And this way, psychologically, it's a win-win, taking the pressure off making the perfect trade. However, a warning: never average prices like this if it was not your explicit intention from the outset. This approach runs the risk of you attempting to double down on losing positions and adding risk and potentially creating huge losses. This strategy should only be employed when you've followed the trading rules, calculated the correct position sizing, and then split that correct position size into various tranches from the outset. This must be a planned move and not an emotional reaction to a trade which you have already placed. Scaling in is best executed with scaling out of a position. When it's time to close a position, but you feel a psychological reason or excuse to hang on to it, particularly if it's in a loss but you feel the fundamentals have changed, then at the very least, just close some of it there and then. Take some risk off the table. The psychological advantage to this technique is that when you do take action, then you're likely to find that it is easier to close the remainder of the position in the future. This can be a particularly useful technique equally for booking profits. It's common for traders to want to hang on to a winning trade to see if it will go that little bit higher. If you take half your profit and leave some in the market, then you have the opportunity to benefit if it goes higher. Yet, if it pulls back, you have still crystallized half your profit at the higher level. Trailing stops can be another useful tool here to help lock in profits when scaling out of a position. Remember, getting in at the bottom and out at the top is near impossible without being lucky. And when it comes to investments and trading, it is always better to be approximately right than exactly wrong.